Chamath Palihapitiya is one of the most famous technology investors in the world. With successful early calls on Bitcoin, Tesla, and more, he has built up an incredible reputation in technology. Well, recently, Chamath has shared why he believes the entire stock market could struggle in the months and years going forwards. So, in this video, we're going to hear why Chamath thinks this and why he believes this negative force could be especially damaging for technology companies. Hi and welcome back. My name is Tom Heavey. I hope you're doing well. I'd like to thank today's video sponsor, BlockFi, but more on them later. For now, let's get straight into our first clip.
I think this is where I think I kind of generally disagree with the market. I think that most people are under the impression that these are short-term kind of contractions and expansions, and that this is just a thing that needs to get worked through the system as we readjust to a post-COVID world, blah, blah, blah. I think it's different. And the reason I think it's different is if you just look at one thing and one thing only, which is that we have a massive labor shortage in America. And there's an incredible stat that I saw, which was the average hourly earnings of non-manager people in hospitality and travel. And the average salary, the mean salary was around 20 some odd dollars an hour, and it's now 33 bucks an hour. And so what that to me says is that we are going through a really sustained period where you cannot get people to do the work that needs to get done. Biden had to call the Port of LA and try to get these guys to be open 24 hours a day. The president of the United States is calling a local port, trying to get it to stay open. But why can't they stay open? Because you have longshoremen, you have all these unionized folks who will expect to get certain levels of compensation, which they deserve in order to do that work 24/7. But then all of that is going to get put through the system. And if you still have millions of jobs that needs to get done in order for the economy to function, the only efficient way that that's going to get resolved is by raising salaries. And those are consistent and persistent. Right? Those things are not just like, oh, you know what, I did say 50 bucks an hour, but now I'm taking you back to 25.
Yeah, you can't take that back.
You can't do that.
That's going to be, that's,
so
yeah.
That's one thing. And then second, so there's people, right? So labor capital, I just think it's getting more and more expensive to get folks to do work. And then there's the raw materials that you use to make anything. And everything that I see is that stuff is going bananas. And so I put these two things together and I'm like, I think this stuff is here to stay. I'm really kind of a little bit of a, and I had not worried. And you can see in every episode before this, I was always consistently like, there is no inflation. You can fade the inflation trade. And now I'm kind of positioning myself to hedge myself in this situation. By the way, central bankers around the world have raised rates. The only place that hasn't gone up is Europe, ECB, and the United States, the Federal Reserve. So, and let's be honest, Europe and the United States, we absorb labor and materials from all around the world, right? We are the net importers. We are the net ultimate buyers of last resort of all of these things. And so if you're seeing inflation in those other, supply-driven economies, they are going to come on shore. They're going to hit us in the face. I think prices are going up.
Okay, so there are some really interesting points here that I'm going to break down and simplify later on. But for now, I'd like to thank today's video sponsor, BlockFi. BlockFi is a fully registered, compliant US company, making cryptocurrency simple for their customers. If you're looking to buy cryptocurrency for the first time, BlockFi are the perfect company. You can purchase your first Bitcoin or Ether in a matter of minutes and know that it's well protected, as BlockFi have over 1 million customers, hold over $10 billion in deposits, and have a remarkable track record in terms of security. Now, if you already own cryptocurrency, you can take it and deposit it on BlockFi and earn an interest rate of up to 8.25% APY. They also offer unique services such as zero-fee trading between cryptocurrencies. Now, we've seen the explosion in recent years of platforms like Robinhood that have made trading on the stock market feeless. Well, BlockFi are doing the same in the crypto space. And finally, they even offer a cashback credit card where users can spend their cryptocurrency and earn up to 3.5% back in the form of Bitcoin. There is a link in the description and in the pinned comment. Use it, deposit some money, and you and I will both receive some Bitcoin. So with all of that said, let's jump back into it.
There was this really interesting tweet that I saw on Twitter. Hopefully, Nick, you can find it. But it was some kid that basically said, you know, I'm growing up in Atlanta and there's a bunch of kids that I used to run with, you know, who would otherwise be in the streets, right? Causing all kinds of trouble. And these kids are now at home, like speccing NFTs and like, you know, posting on TikTok or whatever. It's just a completely different reimagination of like labor and time spent. And that's just a very small example. And so that maybe touches retail or maybe touches, you know, quick service restaurants. But there's all these different things where now that at the end of this pandemic, people are making very different decisions about their time and how to spend their money. And again, I'll tell you again, there's a lot of people. You got to remember how many people in the United States have died or are dealing now with some reasonably important health issues at the back end of coronavirus. 500,000 people, 1 million people. I want you to keep in mind what I told you guys before. There is $70 trillion that has to get transferred down from all these baby boomers down to these people in their 20s, 30s, and 40s. And don't think for a second that they're not making different optimization decisions around perceived wealth. So I just think inflation is here. I think the labor shortage is going to get worse, not better. I think we're going to have to pay people more to get out of it. I think prices are going up. Input costs are going up. Energy costs are going up. So this is it. And
I mean,
I think that probably the Fed and the ECB are really raising. This time next year, they're probably in a really, really tighter posture.
What do you think, Freeberg?
We should also remember that there are going to be some responses from...
Sorry, Freeberg, last thing. Tech stocks in the toilet.
Why?
Because
no bueno
because of
for
multiples?
tech
Because
no
of the
bueno,
multiples?
no bueno for no cash flow growth stocks. Bleh.
Yeah.
In rising rate environment.
Everyone's going to start buying yield when...
Yucky poops. Nobody wants it.
Yeah.
Yucky poops.
Wait, let's explain this to the audience. Why, Freeberg? Why are you agreeing with Chamath?
I mean, once interest rates go up, you'll see that dividend yields will go up, which means stock prices go down because people will expect a higher return. Because if I can buy treasury bonds and make a few points of return on my money, and I'm going to have to buy a stock, I'm going to demand a few more points of dividend yield on that stock. So the price the price for stocks will typically go down to match the yield that you're going to get from these more risk-free investments.
No. To be more precise, a stock is either a promissory note about cash today, or effectively a promissory note about cash in the future. The thing with tech stocks is we tell everybody the same thing. Your money is going to come 30 years from now because we're going to be a monopoly by then. And every dollar that I have today, I'm going to reinvest into R&D and engineering. And in an environment where interest rates are zero, you're happy to do it because you're like, well, great. These guys are investing at way better rates than zero, which is what I get from, my bank. And so I want Facebook and Google and Amazon and all these startups to be putting all this money in the ground on my behalf. But when interest rates start going up, they say, no, hold on a second. I need more money up front, less money in the future because the future becomes more uncertain. And that's the big trade-off for tech companies where they get really pummeled.
Okay, well, is there a number?
Inflation is a good thing. I know people think it's like a really bad, terrible thing. There are certain kinds of inflation that are really productive. We have had to find a way to fight the bad parts of technology. Technology is great. 9 out of 10 things, it's amazing. Efficiency, all these great characteristics that it gives you. But one crappy externality of technology is that it's deflationary. You can do more with less. And that's fundamentally not great for earnings. It's not great for labor participation. It's not great for all these things that people, are really upset about today. So
it's great for the individual company getting those gains.
I actually think it's kind of like it actually balances out the natural pace of technology, which is like you have the natural ability to just actually have cheaper, faster, better, this inherent efficiency that's building up on one side of the ledger. But then what's great is on the other side of the ledger, you actually have labor being able to balance it out. And I think that that's a really good thing because they can demand more to do the rest of the work that's not covered by tech. Look, I'm just going to, I said this on CNBC. I'll just say it again. I think it's coming. I don't think it's a short-term blip. And I think that we are in a period that will resemble the late 70s. And I think that, you kind of want to be risk off and not own risk assets. And by the way, it is hard, okay? Because we are all all of us, all four of us, we're both risk on, and all we own are risk assets that are, it's one thing to say, let's take risk, but you could take risk in like lower of all things. This is like taking risk in the most risky thing. That's what we all do.
And at a time when people have run up the valuations of private market companies to a level that just nobody can understand.
I mean, look, I think you got a year to 18 months to kind of clean this stuff up, meaning like as market participants, we can shuck and jive and get everything into a decent place, but it's coming. And I hope I'm wrong, but I think we'll look back on this and we'll say we said it probably 8 to 12 months before it really reared its ugly head, but it's coming.
Okay, so there are some really interesting talking points here. However, there is one that jumps out. Chamath clearly believes that inflation is coming, and he also thinks it will tank the price of technology companies, especially those trading at high multiples. Now, why is this the case? Well, I'll explain using these two cups. This cup here, this is the return that bonds offer today. As you can see, it's anemically low. Now this cup over here, this is the average return that the stock market offers. Now note that I said average return for the stock market. That's because this cup fluctuates up and down every year. Some years it's much higher than this, while other years it's actually a negative number. Bonds, however, while they might be offering pathetically low returns, they are at least consistent and you know what return you're getting. So if I asked you, which would you prefer to invest into? Which would it be? You'd probably pick this one over here. You'd probably pick the stock market. Even though it's more risky and there's a chance it may go down, the return is just so much higher. But what if I did this instead? What if I filled up the cup for bonds? What if bonds started offering a higher return? Now, which one would you pick? And remember, stocks might go down, whereas bonds, they're much more consistent. Now your answer, it might still be stocks, but I bet you had to think about it a lot longer this time around. And this is the key point. If bonds begin to offer higher and higher returns, they become much more attractive as an investment. If they continue to rise, they could even suck some of the money out of the stock market and into bonds. So if inflation begins to rise, the Fed may have to raise interest rates, which could in turn lead to this situation. And if this day does come, while companies like Apple may lose out too, it is the more speculative companies currently trading at really high multiples that could ultimately suffer the most. Now, one of the things I find so interesting about following the world's top investors is that they frequently disagree. Chamath thinks inflation is coming, while Cathie Wood is worried about deflation. The reason I cover both is simple. It's important to listen to people who disagree. Otherwise, we get stuck in our own echo chambers, hearing the same opinions over and over. And if social media has taught us one thing, it's that echo chambers are not good. So, who do you think is right? Is Chamath correct, or do you agree more with Cathie? Let me know your thoughts in the comments below. Thank you for watching, and I will see you again very soon.